This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and you're listening to News Radio 93.1 WFLA, also simulcasting over there to our friends on the AM dial at 540 AM. On the program today, we're going to do some debunking. We're going to do some debunking of the guaranteed retirement income chitter-chatter that you hear on a regular basis. You hear all this conversation about a 5 or a 5.5% income guarantee. Well, we had the opportunity to run the real numbers. Take pencil to paper, if you will, and see how ultimately that works out. Needless to say, the conclusion's probably going to surprise you given all the advertisements you hear about these guaranteed 5%. But a simple, straightforward mathematical analysis underlies the actual rate of return over time. And folks, that at the end of the day is the real question to ask. Far too many people get sidetracked by the pie in the sky. The pie in the sky. I'm going to get 5 or 5.5% guaranteed. Or even if you want even a loftier pie in the sky, then you should swallow hook, line, and sinker those products that say they will get you all of the upside of the market with none of the downside risk. We've certainly spent prior programs on that topic, but if you missed them, the answer is, yeah, it doesn't exactly work that way. We're not going to spend time on that topic on the program this week, but we are going to spend time debunking the guaranteed retirement income myth, if you will. But before we get to all of that, we've got an email from Jerry we want to tackle. We've got the latest state that is engaging in retirement accounts. We've talked a little bit about this before on prior programs. A lot of states out there that are rolling out their version of an IRA. I just doesn't make any sense. You've got a version of an IRA that's universal across all 50 states. Now you've got different states rolling out different plans that have different features that I think at the end of the day offering more choice does not create greater knowledge. If anything, the past 20 years have taught us all of the information that's available to us, which was supposed to be the great white knight in terms of making more informed decisions. I don't know about you, but last I checked, it's still as confusing as ever. Still as confusing as ever, and the reality is probably more confusing because there's no barriers to entry on the internet. So you got a bunch of morons out there posting whatever they feel like, and then if it gets to the top of the search engine, well, then that must be then gospel. That must be true. Doesn't quite play out that way. So yes, the latest state is Virginia. to start to explore this auto IRA stuff. So we'll talk about that as well on the program today. But before we get to all of that, I do have some housekeeping from last week where Christina Lamb of our office joined us. So that was kind of fun to have some company in the studio. And we talked a lot about the tax changes that were coming up that people are going to see when they do their taxes. And typically every year I do a top 10 tax change list. Well, this year there were so dang many of them that we had to do a top 20 list. So we spent some time hitting a good chunk of them. Didn't hit all of them, of course, because that's a whole lot of information in an hour-long program. But the one that we kind of rushed at the end was the new contribution limits for retirement accounts and retirement plans. So we want to tackle that right out of the gate. Also, if you're interested in looking at the whole list or want to kind of look a little bit deeper on one of the tax topics we covered last week, we did post that on our website under sort of the blog section. So if you go to nelsonfinancialplanning.com and in the kind of the bottom of the home screen, there's sort of 4 different buttons. The button on the far right that says "From the Desk of Joel Garris," that's where you would go to find that top 20 list. We posted it in there as part of our blog rather than a separate attachment, but it's all right there. So we encourage you to go check that out if you want to see some of the big changes and how they might affect you. Certainly lower income tax rates are going to affect everybody. The switch from to the higher standard deduction, well, that's one certainly going to have some widespread impact. And certainly Christina and I last week on the program touched about a lot of those. But the one we rushed in at the end, and I want to just spend a little bit of time on it, fleshing it out this morning, is the higher contribution limits for retirement plans, retirement accounts. And what happens is these limits generally increase based upon inflationary riders. And so oftentimes there's not enough of a difference for them to actually increase the maximum contribution that you can make to these plans. So you go a few years without really any change, and then you'll have 1 year where, oh, okay, now there is a change. And so that is what happened for the year 2019. So if you've got a 401k, 403b, or a 457, your limit just increased for 2019 from $18,500 to $19,000. Okay, so nice $500 bump in terms of the maximum amount that you can contribute. For if you're over age 50, then you get a catch-up contribution that remained at $6,000. That one did not change. So if you're over age 50, the maximum possible amount that you can put into a 401k, 403b, 457 is $25,000 for the year 2019. One caveat, and we always want to point this out, is that particularly on 401ks have a lot of testing and IRS government reporting that has to happen. So if you are what is known as a highly compensated employee, meaning you make a bunch of money, a lot more money relative to sort of the rest of the people that work for that are at that particular employer, and that highly compensated employee definition actually picks up more people than you think it does. The reality is that you may find that you're limited to how much you can contribute based upon some of the top-heavy testing rules that exist on a 401k. So there's always that caveat, if you will, that little asterisk that may affect you personally, but these total aggregate contribution limits are the limits for everybody across the board. We'll slide to the break. When we get back from the break, we'll tell you how much the contributions limits increased, including for IRAs for 2019. So we'll hit that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA, talking a little bit about the higher contribution limits for retirement accounts, retirement plans, on the program this morning. And for 401ks, 403bs, 457s, that number did jump from 18,500 up to 19,000. If you're over age 50, you can put another $6,000 on top of that for an aggregate amount of 25,000. Same thing if you've got a simple IRA, that also did jump by $500 from 12,500 to 13,000. In a simple IRA, which is usually a smaller employer, those over age 50, you can put in an extra $3,000, just like you have been able to do so in the past. The real big change that affects a lot of folks is that the contribution limit to an IRA and a Roth also increased for the year 2019. So the annual limit to fund a traditional IRA or Roth went up from $5,500 to $6,000 for 2019. If you are over age 50, you can add in an additional $1,000 on top of that. So the IRAs they're getting up there pretty good in terms of the annual limit. I mean, maybe I'm aging myself, but when I first started, it was $2,000. Now you can put up to $7,000 in. That's a pretty high limit. And remember, an IRA or a Roth is available to anybody. Now, certainly, whether you get to take the tax deduction or not, or whether you're eligible for the Roth or not, is a function of income. But that's a decent segue into our conversation about all of these proposals floating around out there in the individual states that just, in our mind, just doesn't make sense. You can literally go online, walk into a bank, walk into a brokerage house, walk into a financial planning firm, walk into countless places or go to countless websites and set up an IRA or a Roth. It could not be easier. You can then link that account to your bank account so that you automatically contribute money. And effectively, it works very much like a 401k would work. These proposals by all of these states out there are ridiculous. In many states, it's actually law. Virginia, the latest one to throw its hat in the ring and say, hey, we're going to make it mandatory that if you are a private sector employer, that you must offer the Virginia-based plan if you're got a business in Virginia, if you don't have one in place. That creates a whole mess of problems in our opinion. Okay? Simply because, well, wait a minute, what if that employer has got locations in different states? How's that going to work? The notion that the state's going to set up its own retirement plan with its rules and restrictions and all that. I mean, just stop and think about that. Talk about a perfect example of government waste. Only because the state is sticking its nose in it, when there's no reason to do that. So you're going to set up a state plan. It's going to be state-run, state-administered. Somewhere along the line, there's going to be some expense that goes back to help pay for the cost of setting the plan up, of maintaining it, of marketing it, of packaging it, and of ensuring that it's compliant. that requires cost. That requires people. Where these states think that they're somehow being so paternalistic that they're forcing employers to offer plans when a perfectly acceptable option exists, that there's no barrier to access on an IRA or Roth. I mean, there is no barrier to access. The notion that you're going to then now instead require employers to offer a plan, and oh, by the way, it just so happens that I'm the state that you work, that you have your business in, and I'm going to set up a plan that you must be a part of that's totally separate and distinct from an IRA or a Roth that's offered on the federal level. It makes no sense. And the early numbers, folks, on some of these, so some of these plans out there are mandatory. So state of Virginia's got two different proposals floating around. They got one that says if you are a private sector employer and you don't offer a retirement plan to your employees, then you must offer the state-based plan. The other bill pending is more of a voluntary, meaning that you can volunteer and you go to an online marketplace where different firms can offer their retirement products. Isn't that like what I can already do? Why are so many states getting involved if it's not for a way to make sure that they're tracking your money and ultimately collecting state income tax off of it? Here's how I think this plays out. Because many of the states up north, Massachusetts, Illinois, even states Connecticut, New York, okay? So you set up your state-based plan, okay? How's that play out? Let's say you move to sunny Florida because, well, it's sunny and it's not, 20 degrees below zero and, in this time of year. And, oh, yeah, that's right. Florida doesn't have any state income tax. Oh, wait. Oh, you got a New York. You got a Massachusetts. You got a state-run, okay, plan. You think you're going to be able to take the money out in old New York or Massachusetts is going to say, oh, don't worry about it. We're not going to worry about collecting tax on that? That's not. No. I don't believe that's how that's going to work out. I don't believe how that's going to play out. Why are the states offering it if not for that? They're going to create a program that's going to cost them money? It's going to cost them money. So why are they offering it? It is unbelievable that the states are getting into this. Unbelievable. Perfectly acceptable, perfectly appropriate choices. There's no barriers to access. Okay. Just because your employer chooses not to offer a retirement plan, and there's a lot of different reasons why employers do that. The reality is that if they don't offer one, you actually have greater flexibility to go out and get an IRA on a tax-deductible basis. That's one of the rules that determines whether you can get your tax deduction on an IRA or not. If your employer doesn't offer one, guess what? Then you've got greater flexibility to take a tax deduction on an IRA. But, boy, these states are getting right smack into the middle of it. Virginia joining the rest of the group to try and force people to do a state-run retirement plan. It makes no sense, no difference. I certainly hope that this approach doesn't sweep down to Florida because that would be unfortunate. It's mostly the high-tax states. Oregon, Washington, Illinois, Massachusetts, California, Connecticut, Maryland, New York. What's the commonality there? Commonality is those states don't know how to run their finances in the first place. They should be getting into your business of how you're running your finances. They need to probably figure more time trying to figure out how their finances work because they're doing a pretty crappy job. Last I looked at how high the taxes were in all those states I just rattled off. Anyway, I digress. Well, not really. That was on the topics for the show. One last thing that did increase contribution limit wise. Also, health savings account. Can't say enough about these. These are triple tax-free, really powerful stuff. They go hand in hand with a high-deductible insurance plan. Big fans of these. That did increase by $50 up to $3,500 for individuals. Family plan contribution limits increased up to $7,000. If you're over age 55, not 50, 55, you can kick in an extra $1,000. Those are the new limits. We'll take a break. When we get back, we got to get to this debunking stuff on this guaranteed retirement income here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. On this part of the program, we're going to try and do a little bit of debunking, if you will. A little bit of debunking on this guaranteed retirement income nonsense that you hear so much about. First and foremost, in order to get the guaranteed retirement income, guess what that means? Oh, you're getting into an annuity. If you haven't checked out annuities, generally they're pretty expensive. And they also happen to pay the highest commission in the business. So that's why you hear everybody loving the annuities in the financial services world, because they pay a big fat commission. The reality is that they tie up your money, subject you to surrender charges and much higher expenses, and give you great sounding benefits and riders that at the end of the day do not play out the way that you would expect them to play out. So here we go. This is going to be a little hard to follow on radio, but we're certainly going to give it a shot because it's a pretty important topic. We're going to be throwing a lot of numbers around. This is all pencil on paper stuff, just a straightforward analysis on, okay, what the heck is going on with this? And for that matter, how is the insurance company able to offer this fabulous guarantee of 5.5%? Well, you'll soon find out that that's not really what it's going to cost them out of their pocket. No, not at all. So here we go. Ready? This is a real example. Person has $275,000. $275,000, received a guaranteed retirement income quote equal to $15,000 for the rest of their life. Okay, so there's your starting point. I got $275,000. The insurance company is offering me a guaranteed retirement income that is basically 5.5%. This one was 5.5%. Some of them are 5. This one was 5.5, equal to how much I'm willing, how much money is invested, and so $15,000 for the rest of my life on a $275,000 investment. Okay, so that's the starting point. Okay, now as they get income, what you have to realize is that as you get that $15,000, okay, it reduces down the death benefit of the principal invested. Okay, so like most annuities, they give you a death benefit equal to your original contribution of the $275,000. As you take money out, so you take $15,000 out in year one, the death benefit is going to slide down to $260,000. Okay, so know that as you pull money out under these guaranteed retirement income, you are reducing your underlying death benefit. What you're also doing is understand that the underlying expenses of the contract are eating away at that variable amount that you have invested. Okay? So at 2.5, if you can find it at 2.5, you're lucky, usually closer to 3, that level of expense Plus, remember the withdrawals also reduce not just the death benefit, but they also reduce the underlying sum of money in the contract. Okay, so now you're taking out $15,000, which is 5.5%, and oh, by the way, the expenses are 2.5 to 3. So we'll do some math on that, and that gets you to 8.5%. Well, wait a minute. If my underlying balance is getting eroded by 8.5% per year between how much money I'm taking out based upon the guaranteed income that I'm taking out and the expenses, and the long-term performance of the market only going to get me 8 to 10, well, then that principal is ultimately going to go down. It's not going to go up because of the rate of money that I am taking out. So stop and think about that for just a second. I mean, those are the numbers. How on this investment am I somehow ever going to stay ahead from an investment perspective? Am I ever going to stay ahead of an 8.5% effect reduction on my underlying investment? Sure, maybe if the market does well and you get ahead, but the second the market goes down, then you're really going to be eroding that underlying value. Still have your guarantee income. Okay, fine. That's fine. Okay. But the faster then that you get to a decline in the value, the more then that starts to accelerate, right? So let's say it's a year where the market goes down 10%, or even last year, the market went down 6%, right? So, but then the expenses were 2.5 and you took out 5.5. So now you're down 14%. Well, guess what happened to your 275? That's down 14%. So now your 275 entering this year is, let me just do the math here real quick, is 236. Well, now the 15,000 is not 5.5% of what you invested. The 15,000 is now 6.5. See how that continues to increase the percentage if the balance goes down and you still have the same level of income. Okay, I still get the same level of income, but if my balance of which I'm drawing on is less, well then I'm gonna erode that thing at a much faster pace than you can really appreciate. That's kind of how those numbers work. Understand the bogey. You got to get above 8. In the years where you don't get above 8, you're going to massively accelerate the decrease of the underlying value. Okay? All right. So let's go back to our example. Excuse me. Age 65. And let's put 25 years on her. Okay? She's going to live for 25 years. Over that 25-year period of time, there's going to be enough fluctuation in the market. She continues to get out her income of $15,000. The reality is over 25 years, she will pull out at a guaranteed income of $15,000. She'll pull out $375,000. But because she's pulled $375,000 out, her original $275,000, there's no death benefit associated with that because those withdrawals count against the death benefit. Similarly, if you just have a kind of a normal market up and down over the next 25 years, well, there's really not going to be anything left in the underlying value either. And that's the piece that people miss. That's the piece that they miss, is that what's happening to the underlying value, the underlying dollars in the contract, is they're constantly getting eroded by virtue of the expenses and by virtue of the income that you're taking out. The second you have a wiggle in the market, even a slightly down year like last year, then the whole thing is going to rapidly run to zero because those withdrawals and those expenses still apply. And those withdrawals serve to further increase the decline of the underlying balance of the account. So what happens after 25 years? Well, there's nothing left in the account, but you did get your guaranteed income. Okay, great, fine. If you start that at 65, you live 25 years, you're up to 90, your guaranteed income that you got was $375,000. Okay, great, fine. You're dead, you die at 90, okay? Now, what's the rate of return? The rate of return is a calculation that we're going to do, but we're going to have to do it after the break. When we get back from the break, we will give you the bottom line number on how these guaranteed retirement income benefits actually produce in terms of your rate of return. So stay tuned for that here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris of Nelson Financial Planning. On the program today, this part of the program, we're debunking the myth of guaranteed retirement income. You hear all these advertisements of, oh, you're going to get 5.5% guaranteed income. Here's how it plays out. We spent some time last segment sort of setting up some of the background details on it. Basically, look at a $275,000 investment. You're going to get a guaranteed income at 5.5% of about $15,000 a year for life. The problem is that the contract carries generally 2.5%, 3%, sometimes even 3.5% underlying expenses, and the $15,000 that you're taking out, which is 5.5%, counts towards reducing the underlying death benefit, and also, for that matter, reducing the underlying value of the annuity contract. So guess what happens? Over 25 years, there's nothing left in that contract. That's the part that they don't really talk about. But when you look at these numbers and run these numbers and think about market cycles, particularly over long periods of time, there's not going to be anything left. One slightly down year is going to rapidly accelerate the decline or the decrease in the underlying value of the contract. And once you have that, you ain't ever going to get above. You're not ever going to get above that 8% threshold that you've got to get above between the expenses and the income that's coming out to add actual value back into the contract. Of course, your relative rate of income is no longer at 5.5% when the value goes down. It's at 6.5%, or it's at 7%, or it's at 8%. And then that's when you start to really see where, okay, this is really going to accelerate. At the end of the day, 25 years later, there's not going to be anything there. But you did get your guaranteed income. Okay, great. So you got 25 years of income at $15,000. Congratulations, that's $375,000 that you picked up over a 25-year period of time. Sounds good, right? Okay, here's where the math comes in. What's the rate of return on that? Little math question for our listeners. I have a $275,000 investment. I got $15,000 a year from it over the course of the next 25 years. There's nothing left of the $275,000, but I got $375,000. What's my rate of return? Okay, here we go. You got $375,000, right? Start with $275,000. You made $100,000 over. Wait for it. 25 years. So you got to spread that out in order to figure out what the annualized rate of return is, right? So if I make $100,000 over 25 years, well, how much do I make per year on that? That per year means I made $4,000 on what was my original investment? $275,000. Yeah, the math comes out to be 1.5%. You're not getting 5.5%, you're getting 1.5%. Very simple math. If you lost track of the analysis, We're going to post the program as we always do on all the various social media channels that we have channels on, YouTube, Google Play, iTunes, you name it, we're out there. You can also just go to our website, nelsonfinancialplanning.com, and click on any of the icons in the upper right-hand corner, and they'll take you to all the various channels. The actual return, calculating it, pencil, paper. Okay, how much money did I get? What did I start with? Over what period of time did that occur? What's the number? It's 1.5. It's not 5.5. It's 1.5. Does that start to kind of make a little bit more? Hopefully that makes sense to the point where you're saying, well, yeah, that does come in. Because you know what? At the end of the day, that insurance company, whoever that might be, they're not giving me something more than what the historical numbers are. The historical numbers on anything that's guaranteed, insured, or anything like that, whether it's a CD or money market or what have you, that, in fact, is a period of 1 to 2%. If it's 1 to 2%, guess what? Well, it's no different. No different. And the insurance company knows that. So now, guess what? Now you know that. So be careful when you hear the conversation about the guaranteed retirement income. Yes, the income's guaranteed. I'm not arguing that. But take pencil to paper and run the numbers and see what the actual rate of return is. There it is. Not nearly as what you thought, is it? The 5.5% is a classic bait and switch conversation. That's what it is. Anyway, hopefully we've debunked that with some actual numbers rather than an emotional play on a guarantee. Because that's really how those products are sold, is based upon an emotional play on a guarantee. Anyway, let's change gears and go to the mailbag, or should we say the email bag. This is an email from Jerry, and Jerry actually reminds us that we did an email to our clients about a month or so ago, and then also converted that over to a blog post on the website at nelsonfinancialplanning.com. And we compared, we have been training for a marathon, and we compared running a marathon to investing. Like if you've ever trained or run over a long distance, you know that some of the miles feel great and go well, and some of them don't. And at the end of the day, that's much like investing. But if you stick with it and you soldier on, the reality is that you will accomplish your goal. And so that was the analogy that I was drawing to our clients and on our blog about a month ago. And so Jerry's email is a good reminder that I need to now give you the update on that, because I was targeting the Disney Marathon, which was last week, and we did successfully complete that. So yay us. The first half was those were good miles. Okay, those were smooth, those were easy, and kept a good pace. And then there was some miles in the back half of that race that were a little tougher. So the analogy very much remains that running a distance like that is very similar to investing over time. Not every mile, not every time period is perfect, but ultimately over time you do reach your goal, whether it's investing or rather it is running. So, Jerry, thank you for mentioning that in the email about how the Disney Marathon experience was. It was good. As a matter of fact, I think I'm going to probably try and give it another shot next year. I'm not sure that I'm going to be starting to run multiple marathons in the same calendar year, but maybe one per year might be a good way to stay in decent shape. Jerry's actual question in his email has to touch on algorithm trading. And his comments are that, the stock market runs on such a system, and a lot of the wild swings in the market of late certainly does make a lot of folks run for the door and get out of the market, only to find themselves missing out on those important days when the market moves positive after a downturn that was pre-programmed. Jerry continues in his email, I've read much on the subject only to find that the math involved and the computer program involved would boggle the mind, but it might make folks less fearful of the wild and unexplained market movements. And I think that's a very, very fair point, Jerry. We actually put in our correspondence to our clients here at the beginning of the year that 85% of the trading in the month of December was, in fact, program or algorithm trading. Folks, there's a lot of computers out there, okay? The computers have been out there, and they've been out there kind of messing with the market going all the way back to 1987. Black Monday was triggered by computers. Be very careful of those short-term moves. They do, in fact, catch a lot more attention now, and they have a tendency, I think, to get a little bit more exacerbated, as Jerry points out in his email, because of algorithm trading. That should not be a reason why you, the long-term investor, throw in your towel. But yet, last month, the month of December, was the greatest outflow of dollars from stock, equity, mutual funds ever. So a lot of people made a lot of bad moves. Jerry, your email is absolutely on point. Thanks for sending it our way. We will have to wrap it up because we're out of time. So we are out of here. Thanks for listening. Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.